Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, welcome to the Smart Investing Show. I am Brent Wilsey, president of Wilsey Asset Management, and we got a great show lined up for you today. We're going to be talking about the global economy because, yes, the global economy appears to be dropping dramatically, but we'll talk about, well, there's some bright spots there. And then also, too, Costco. I love going to Costco, but investment-wise, well, we're going to break that down a little bit for you, maybe talk about things that investment-wise, you may not want to know.
And Chase Wilsey from Wilsey Asset Management here as well. Always here to take your phone calls. You want to join the show, have a question about the economy, the stock market, of course, those individual stocks, which I know a lot of people like to call in about. Phone number is 833-288-0973. Again, that's 833-288-0973. We're also going to be talking about the month of September. If you haven't noticed, it wasn't a great month, but we got some good news for you here. So we'll break that down in a little more detail.
All right. Well, let's start off with the global economy because it is dropping dramatically. But the U.S., well, the U.S. is the bright spot. I always tell people we do not depend on the world to buy our products. We buy the products from the world. Some bright news that might help you hold on during these difficult times is, according to the Wall Street Journal, some U.S. manufacturers are bringing back production from overseas to the U.S. and are boosting investment here.
And the other thing, too, is it should be noted that contracting U.S. business activity was better in September than August. The U.S. Composite Purchasing Managers Index, which includes both manufacturing and the service sector, climbed to 49.3 in September, a nice improvement from the August showing of 44.6. We are not out of the woods yet, but do not sell your quality equities that are well priced and have a good business. And don't forget to look down the road a year or two and not a week or two. And I got to say, it's still a contraction. Mm-hmm. You know, we still like to see that number above 50, which means it's an expansion. It's a little disappointing to see, again, another contraction. But 49.3, we're pretty close to an expansion. Could be a rounding or two. Maybe it was close to an expansion there. But, I think we could see some positive news from this as we exit the year.
And one thing the news does is they do focus on a lot of the negativity. And yes, I am concerned. I feel bad for people in Florida because of the hurricane and so forth. But it was on business news a lot. It was everywhere. And it really brings you down. Mm-hmm. And they don't like to bring out the bright spots like we do here. We want to give you the best. Because actually the mainstream media, get all the bad stuff there. We'll try to look for things that can help you out, get you through these bad times, because there are good things. And the strong dollar, that is a positive for our on the inflation side, because if you're buying other products across the pond, well, you're going to get a lower price for them because of the strong dollar. So it's not all bad, and that's why people say, oh, this is terrible, it's going to last years. It's not going to last years.
And the other thing, too, that I'm wondering on this, especially in manufacturing in particular, and I guess service sector too, but we saw Nike report this last week, and they had a huge inventory build. I think it was like 66% in the United States or North America was the segment, and that, of course, is they're going to look at saying, well, we don't need to make as many goods because we have so many in our stores. We got to liquidate all these first. So that could be some of the issue with these manufacturing purchasing index and so forth, is just because I think a lot of retailers built a lot of inventory, but we've talked about this in the past. That's also a positive for inflation because Nike has their new merchandise that they'd rather sell. They'll have to discount their old merchandise, which should help push prices down here in the short term.
And what's coming up is Christmas time, so you might get some great deals on not just Nikes, but a lot of apparel has the same situation. So there'll be some great deals out there for Christmas time, which is good. And the thing too, it shows that the supply chain has improved, because before, there's no sneakers. I do wonder, remember that sneaker fund they had?
Yeah.
Wonder how that's doing.
Yeah.
And not Nike, but there's some fund out there where, they had all these high-end sneakers in there. So,
Yeah, I don't know if the price of sneakers have been like the NFTs that just right on down.
Yeah. And I just thought something else that NFT could stand for, but I can't say that in there.
Not a fun time.
Okay, we can use that one. That was the one I was thinking. Also, too, I talked about Costco. I love going to Costco. I know many people love going to Costco. You get some great deals in the warehouse, but one deal that is lacking is their stock price. The stock is down about 20% from the $600 high, but with the PE ratio still over 37. Well, that is no deal. They do have some great businesses, a great business model, and there's potential membership price hike perhaps next year.
Even with that, 48% of Costco members in a recent survey said they're willing to pay more for their memberships. Costco depends on increasing volume, however, as the profit margin always hovers around 3.6%. If volume falls off, the stock price could tumble as well. Because as you said, their margin likely is not going to expand. Their whole thing is they buy in bulk and they sell in bulk.
Right.
So they're able to get great deals and sell at a great price. If they're not able to have a lot of turnover on their sales, that's not going to be an easy way, or I think really a possible way for that matter, to grow sales and grow earnings.
Right. And we talk about the reason why you would pay, 37, 35, whatever for the PE is for that growth. Well, there's only so many people that are going to be going into Costco because I've talked to people and they said, well, I got this little apartment. I can't get a big thing of toilet paper and this will take my whole living room. So their growth of people coming will be slowing down. Yes, they will pick up people that are trying to save money, but eventually they're going to hit that ceiling and the stock could tumble dramatically. And it's a great business. But they're going to have problems because you cannot keep growing. And they got a very simple business model. Yes, their memberships are going up. Yes, that goes right to the bottom line. But to be trading at 35, 37 times forward earnings is just way too expensive. And that means the stock could be cut in half.
Yeah, I mean,
current levels.
It's just, I don't know anybody that does know about Costco. I think a lot of people are already members that want to be members. So again, as you kind of said, a lot of times these companies that trade at 36, that's like a freaking software company that's growing sales and earnings at like 20, 30%. I'm sorry, Costco is not in that category. and they do get the subscription revenue, as you said, which I know Wall Street likes to kind of favor because it is reoccurring. You don't have to push products. You're not going to have as much cyclicality. But, gosh, that is expensive.
Yes, it's very expensive. And again, love Costco. But what would be nice to kind of look at, and we don't hold Costco, so we're too expensive for us, but the growth of their membership. Because that, as you said, everybody knows Costco. I don't know who you would talk to. Like Costco, never heard of them.
Yeah.
Everybody knows not just the name, but what they do. But when I was single, I didn't, I go to Costco. What do I need? Toilet paper is going to last me for a year. What do I need? 24 eggs that's going to last me. I think actually
it's like 48 or
48
60.
eggs. It's even more than that. Yeah. So, but that's just not going to change. So I think Costco, I'd be very leery if I held that stock, and not that's going to drop tomorrow, but it's going to have a very hard time. I'd say over the next couple of years, probably.
Yeah,
so.
It's just you never want to be the guy that overpays for it. And it's funny, you go to Costco, you get a discount. You're not getting a discount on that stock, that's for sure.
Exactly. Well, let's talk about the market because, yes, trying to time the market has always proven to be a dangerous game as it is heavily reliant upon one's emotions. In the long term, you have a better chance of actually, we think, winning the lottery. Many people don't realize how quickly stock prices can move. And by the time stocks have risen, well, they're left asking the question of whether they should get back in or will they fall again. Looking over the last 40 years, the 10 best days out of more than 10,000 accounted for almost 2/3 of the stock market return. And, well, in the last 20 years, the best 10 days accounted for 75%.
Yeah, let's look at the numbers here a little closer. Through the beginning of this year, the market returned close to 300%, 284% to be exact, over the last 20 years. But had you missed those 10 best days, the total return was just 76%. Now, the funny thing is, the massive up days all came in the most difficult years of 2008, 2009, and 2020. The single-day returns range from 6.3% to 11.6%. Again, I'll repeat that. That was a 1-day return that you could have seen a double-digit gain. I mean, that if you missed that, that just crushes you. Nobody knows what is going to happen in the short term, as there are too many variables to try and predict. That is why owning great businesses at great prices has proven to be a successful long-term approach to investing. And the reason that I say this here is on that single day, let's just say the market goes up 10%. Oh, that's not going to happen. It's happened before. It could very well happen again. What do you do then? You're on the sideline. Oh, this market is going down. Oh, went up 10%? Oh, no, it's going to come back down. And then all of a sudden it keeps going up. Do you get back in? Do you wait for the crash? What if the crash never comes? What if 5 years from now you're still in cash? Now you're totally screwed. You've screwed yourself. And if you sold out at a loss earlier this year to wait for things to go even lower, well, now you locked in that loss, and now you're sitting on cash still. We still have inflation. You're totally screwed.
And you know what's hard, Chase, is that the theory makes sense. Well, if I sell before it drops, I can buy back in when things are lower. Yeah, perfect.
You're right.
But you don't know when that's going to happen. And the thing is, and you made a great point too, that the single day returns from 6.3% to 11.6%. Again, that's for one day. Those are during very difficult times when your emotions are probably like, oh my gosh, this is terrible. I got to be out. Oh, what happened? And then your emotions take over even more, because then, well, it went up, so it's got to come back down. And it doesn't come back down, and then goes up again. Oh, and we do this at our workshop, which we have one coming up in November, the 19 Thoughts to Trading. And it has proven right every single time. You'll be right a little bit of the time, but you're not going to be right all the time. And that's the problem. And that's why the average investor over the last 20 years has averaged only 2.9%, well below the returns that we talked about here, 20 years of about 284%. It's just terrible.
Yeah, and as you said, I mean, the concept, you're 100% right. If you sell out before things go down and you buy back in before they go up, yeah, your probably average return is going to be 200% a year. I mean, it's going to be great. If you could time that, because you're not just timing it. I mean, we know that the market drops about 14% on average per year over the last, going back to 1980. If you could manage that, I mean, if you could time the market, that is the best way to get the best returns. But you can't do it. And especially what I tell people is you're investing for 20, 30, 40, 50, 60. Some people are still investing for 70 years here. Maybe you do it once. Maybe.
Right.
But you're not going to do it for 70 years.
Right.
There's no possible way.
And I've been managing money for 43 years. I've had people try it, and they were so happy because they got out. Oh, I'm so happy I got out. But not one of those people has ever come back in at the right time. They just don't do it, and that's so that's a 0% chance that you can do well doing it. And I still hear it from people, and they still think that they can do it. And it's again, in theory, sounds good. In reality, practice just doesn't work.
And I think we've talked about this on the show before, but the reason it doesn't work is because the emotion that's telling you to sell is going to be the same emotion that's keeping you out from getting back in to buy.
Right.
And when the stock market bottoms, you're not going to feel good because things are still going to be bad. And we could be in a recession next year. I think we're still in one currently, but you could still see recession-type signals next year, and we could be in a difficult time, and the market could rally. But that's because now the market is anticipating recession, and now we're going through the recession, and we're anticipating that we're coming out of the recession. Now that market starts to go up. Things will not be pretty. Right. And that's why the emotional side of timing the market never works. It's because your emotion is never going to say, this is a great time.
Here's a good example of that. Went through, obviously, 2008, the Great Recession and so forth. The markets turned in March, I think it was March 11th of 2009. Things still look very bad.
Oh, yeah.
But that year, if you were on the sidelines, I believe the market was up, I want to say 30 to 40% that year. So if you were still feeling bad about like, oh, this is terrible and housing crashing, because it's still going on, but the market turned around.
Unemployment rate was through the roof.
Yeah. It was a terrible time, but the market went up. And the same thing will happen. There'll be some catalyst that will turn things around before your emotions have turned around and you're left with a train just flying by you and you can't jump on that train because it's going too fast, and you missed it. That's why, again, average investor 2.9%.
Yeah, and we already know the market's down more than 20%. It's in a bear market.
Right.
And I don't know, people think, it's going to go down 40%. Well, let's say it goes down 38%, and then it rallies you missed your change. Right. Yeah, it's a ludicrous idea. And I will say, we've talked to people, I'm still not as excited about the market. I think now the S&P 500 over the next 10 years from this point is going to do okay. Right. I think now the valuations are more justified. I thought at the beginning of the year, the S&P 500, the NASDAQ was way overpriced. I'm still curious about the NASDAQ. I think there's a lot of froth still in that index. But the S&P 500, since it's a market cap weighted index, I think you're going to have some reversal in what carries the S&P 500. But Apple still makes up about 7%. I think there's still too much concentration at the top, where I think over the next 10 years, there's a lot more better opportunities out there than investing in the S&P 500. Again, the value companies. But I think now the S&P, it's not like we're going to stay down here for years.
Right. And back when index investing was hot, and just do the index and so forth. I said, yeah, it's been hot over the last 40 years, 3 or 4 times. It comes and goes, and now it's going to be going on the outside, where it's going to be very easy. I shouldn't say easy. It's going to be very possible to beat the index by buying good quality businesses at good prices, because there's just too much froth in the index, and it's still 5 companies still make up 22% of the index, and those companies are very pricey. Which one or two things will happen: either they will drop dramatically, or they're going to stay at that same level, bouncing back and forth, we'll say 20-25% range for the next 5, 6, 7 years. So that's why you got to really look at what you're investing into. But again, you can't let the emotions control you. Let's talk about September, because as we anticipated, September has been a difficult month, but we still remain extremely optimistic about our businesses, with many now trading at 6 to 8 times forward earnings. Remember, the long-term historical average is about 16.6. Much of the sell-off has been driven by fears over the Fed hiking interest rates.
And I want to take you back to 2018, when Fed fears led to a stock market sell-off in the month of December of a close to 16% in that month alone. And I remember Christmas Eve. It's like, well, this is a great way to start Christmas.
Yeah, it was down 16%. Like, what is going on? It was a terrible Christmas.
Yeah.
Down 16%.
Yeah, and again, that's from December 1st until I think it bottomed around December 26th. Yep, December 26th, down 16% in that time frame. That's a very, very fast fall.
You guys got no toys that time.
Yeah. and the reason was the Fed was raising rates, and it was feared they were going to increase rates 2 more times in 2019. This ended up being an overreaction, and the Fed ultimately ended up cutting rates in 2019. This led to a rapid increase in stock prices, with the market climbing more than 19% from its low on December 26, 2018 through just February 22nd. So less than 2 months. The full year 2019, just remember, the market climbed 29%.
Right.
So things, as we've been talking about, can turn very, very quickly. And does that sound just a little bit familiar? Oh my gosh, the Fed's increasing rates.
And I want people to remember, and by the way, we're going to open the phone lines. You want to call for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Give us a call here, 833-288-0973. Again, that's 833-288-0973. But Chase, we want to remember who the Federal Reserve Chairman is.
Chairman Powell.
But what he has done, remember, I think now about a year and a half ago, inflation's transitory. He changed quickly. And then he went from one side way to the other side. Now I think he's going to realize, oops,
went too fast,
did too much. He could change. How many? I think there's 2 more meetings before the end of the year.
And they're anticipating, I think it's 1.25.
Yeah.
In those last 2 meetings. Right.
And what if, and that's the second, maybe the next meeting he still does something, but the data is changing quickly. And he could, again, he's, I'm tough on inflation. Oh, shoot, I went too far. He has proven that he will change his mind very quickly. And if he does that, watch out. I think the markets will rally dramatically after he changes course.
And the thing is, again, 1.25 by the end of the year. 2 meetings.
Right.
That means that's another 0.75 point likely the next meeting, and then half a point.
Yeah.
I mean, that is, for us to not do a 3/4 point hike in years, and now all of a sudden we're done, what is that, 3, or would that be 4?
Right.
I don't remember how many we've done now so far this year, but that is a huge, huge step in trying to really ease that inflation.
Right. And you know what's great about investing is that I would love to say I'm right all the time. I'm not. But what I look at is that, okay, what if I'm wrong? What if we're wrong and that he still does not realize that he shouldn't be raising rates so much? Okay, so now you flow into 2023. 2023 could be a boom year because, again, rates stopped increasing. And you talked about, too, that in the last time, not only did it increase, they decreased. Because if things reverse very quickly, he will reduce rates. So that's what's great about investing. If you buy the right businesses at the right price, and it is funny because when everything's going fine and so forth, people come over, I've been with you for 3-4 months. You've only invested 40%. Yeah, can't find anything to buy. We tell people when they come in for an appointment now, we're going to buy probably about 90% of your portfolio we're invested as soon as the money comes over because there's great buys out there. But it's not the high flyers. It's not the names that you know. And you recognize the names if you're with us. You recognize, the names you know, but not the popular names, I'll put it that way.
Yeah. It's just, it's always going against the emotional grain, I'll call it. You want to buy when nobody else wants to buy, and you want to sell when nobody else wants to sell. Yeah.
And I've been doing it for over 40 years. This is my 17th correction I'm going through. It's never easy. It's not like, oh, yeah, this is great. I'm all happy. Well, I'm not happy, but I accept it. It's kind of like when you take medicine. You don't like the way it feels, but you know it's going to make you feel better.
Yeah.
Same thing with investing. You don't like the way it feels, and it's very hard to buy when things are down because you're going against the wind. Everybody else is like, oh, get out, get out. No. If you look at the fundamentals of the business, like, wow, this is a great time to be buying. And that's how I've been successful, is buying when things are down. Here's the other thing that people say, too. They also say, too, well, yeah, but I'm down now and I don't have anything to buy. That's okay. Just be patient. You will come through it. And don't look at your 6-month return or 12-month return. Look at your 5-year return, your 10-year return. You will do very well during that time frame by not panicking, selling out, as we talked about, trying to time the market.
And that's one thing, too, that I was talking about on Fox 5 this past week, was you got to understand the businesses. And it's so cliche because everybody's like, oh, understand what you own. And you got to take that a step further. You can't just know the name of the stock, what the stock does. People are like, oh, I love Peloton. I have a Peloton, so I'm going to buy Peloton stock. Mm-hmm. Well, do you know the fundamentals of Peloton? Do you know their profit margins? Do you know what their sales are? Do you know their debt levels? No, but I know the bike. Don't buy the frickin' stock. That is a terrible idea. Just because you know the product, it could be a terribly run business. And when you hear that advice, understand what you own, it means understand the business.
Right.
That's step one. Understand what the business does, but then you got to understand the fundamentals of it, and that's what's going to get you through the tough times. And I bring up Peloton, because I've talked about this. It had a high of over $160 a share.
What's it, 160?
Yeah. It now is around $10 a share. Not going to 160 anytime soon. I don't think it'll be back at $160 maybe for 15, 20 years.
I was saying my lifetime. I think even your lifetime.
Yeah, it's just ludicrous. And Zoom's another one, $500. I know Zoom. We use Zoom to do presentations for people that can't make it to the office and so forth. $500 a share, now at $100. Yeah, it's not going back to $500 anytime soon. You don't want to buy those companies, and that's that term, catch a falling knife.
Right.
You don't want to do that with companies that still trade at, let's say, maybe they get cut in half and they still trade at 40 times earnings. Don't buy that stock.
And I want to reiterate what you said, too, because, Peter Lynch, great investor and so forth, he said, buy what you know. And then people will take that like, oh, well, I know Costco. I know Home Depot. I'm going to buy them. But that didn't mean that's where you stop. You brought the great points like research. Let's say buy what you know, but research it before you buy it. And if you don't understand how to research it, then find someone that does know how to research it. Because just buying something because I know that's a terrible game to play. And there's been many companies that went bankrupt that you knew them, and Toys R Us.
Yeah.
Gone.
Oh, I went to Toys R Us as a kid. I'd love to buy their stock.
Was it Jimmy, Jeffrey, the big giraffe?
I think it's Jeffrey, yeah.
Yeah. It's like, and you felt so good there, but you didn't research the company and say, wait a minute, they got a lot of debt. The profit margins are terrible. So don't just buy what you know. Buy what you know after you research it. That's what you want to do. All right, phone numbers here, 833-288-0973. That's 833-288-0973. Let's go up to Temecula and speak with John. John, you're on the Smart Investing Show, Brent and Chase. How can we help you?
Yes, good morning, Brett, Chase. Appreciate the call.
Thanks for being there.
I'm looking to round out. I'm looking to round out my REIT portfolio. And I'm looking at DLR, which is a digital realty trust, and kind of houses all the data warehouses for all the companies, pretty much worldwide.
That's interesting. Do you hold that, or you said you're researching it? You haven't bought it yet. Is that correct?
No, I'm about 5 minutes away from making that buy. So that's why I'm calling you.
5 minutes, yeah.
5 minutes. I was going to say you're probably about 48 hours or something.
Well,
yeah,
in my mind, I should say. Yeah, in my mind.
There we go.
So.
Well, let's take a look at Digital Realty Trust, DLR is the symbol there. They're on the REIT specialty index here. They only have 3% float, which is very good. 97.9% institutional ownership. PE ratio 21.7 versus 27.9. Price of sales 6.3 versus 6. Price to book value 4.5. The industry not materials. That's a positive there. And then price of cash flow 17.3 versus 16.8. So not a great deal on the valuations there, but not a bad deal. We do see on the earnings per share over 1 year up 94.1% versus 21.4. I would be suspect of that when I check how they got 94% growth on their earnings. We do see sales are up 3% below the industry at 9.4. And bad news here, the 5-year earnings per share growth estimate from the analysts, they're looking for a decline of 44.2%. That's just terrible. The industry up 9.2. So why is Digital Realty Trust looking for earnings decline by 44% over the next 5 years? You got to understand that before you get the company. We do say they pay a nice dividend of 4.9%. That's above the industry at 3.4. They do use 104% of the earnings to pay that out. On the balance sheet, we see a current ratio of 0.3. Wow, that's very low. The industry is at 1.2. That shows not a lot of liquidity in the company. That could be dangerous. Their debt's not too bad, 0.9 versus 3.9, but that current ratio of 0.3, I'm a little bit worried on them paying their bills. They do have a good profit margin, 29.7 versus 21.1. Return on equity also low, 7.6 versus 22.2. Chase, what do you got?
Yeah, there's some thoughts on the company here. It looks like they own and operate nearly 300 data centers worldwide, has more than 35 million rentable square feet across 5 continents. One thing I'm thinking is 300. It sounds like a lot. I would just want to see a little bit more of like, are there any particular customers that they really work with in particular? Are there any heavy concentration in those data centers? Because what if one of the data centers all of a sudden gets like hacked or it blows up or something happens there? That would be detrimental to a business like this. So I just want to understand a little bit more of the nitty-gritty details on those data centers, because I know that people are moving to the cloud and we need data, so it's not like this is something that's going to be gone tomorrow. So I think it's definitely an interesting business that's going to be valuable to us for many, many years to come here. So I think it's quite interesting, and you don't have to worry necessarily about, do they have the best tech to kind of keep up with their competitors? No, they're just housing it. So they have the real estate behind it.
I like the concept,
that. But current price here for Digital Realty Trust is $99.18. I see 52-week high is $178.22. And 52-week low is $96.08. Year-to-date return down about 42%. So definitely getting this thing at a much lower price than where it was. And I think a lot of real estate investment trusts have been just hammered with rising interest rates. And I think it's sell first, ask question later.
Yeah.
And I think it's presented some great opportunities in this market, especially with a lot of dividends for these real estate investment trusts. Now, going forward for the business, again, Digital Realty Trust, ticker symbol DLR. go out to December 2023, I see the FFO estimate, again, funds from operations. We utilize that for the REIT, $7.27 would give us a target sale price of $120.68. So about 21%, I'll call it, away from the current price. We normally like to have a 30% margin of safety. So I know you said you're about 5 minutes away from it. I might just try and be a little greedy with it and try and get a little bit lower price, just because, again, we stick to that discipline of that 30% margin of safety. But other than that, I like the concept. I think the earnings per share thing, as Brent said, something to look into. But my estimate is because their earnings went up so much, is maybe it was a sale of something, and now they're not going to have that sale going forward, and that's going to be a hit to earnings, but not necessarily a hit to FFO, as I see that's supposed to grow mid-single digits there.
And John, I'm still worried about that. Why is that 5-year earnings per share growth a negative? I did look at the balance sheet for you. They've only got $1.3 billion in cash on the balance sheet. Now, they do have $14.2 billion in long-term debt. They do have real estate, but there's a slowdown. Something happens, as Jay said. They're going to have major problems. How are they going to make those payments on those mortgages?
I really believe, and again, this is an estimation here.
Sure.
But the reason, because their earnings went up 94% in 1 year. Mm-hmm. So I think that's from the sale of something.
That
right. Didn't go to FFO. Okay. So now all of a sudden their earnings aren't going to be as good for the next 5 years because they're not going to have that sale that occurred this year. So that would just be my estimation. But just confirm that. I think that's a likely case because their FFO is still continuing to grow, which is for these REITs more important to me than the earnings, because that and I don't want to say earnings aren't important, but they can be very heavily skewed by the sale of different properties.
And John, I'll let you know, we were kind of looking for another REIT in our portfolio. We've got a couple. One we can't buy. It's overpriced now. So we've been kind of looking for another one. It's very hard to find one. I would love to say, yes, John, this is it. We're going to buy this one. I just don't feel comfortable with this one. So as Chase said, don't take 5 minutes. Maybe take 10 or 15 minutes to go a little bit deeper. All righty?
Yeah, thanks. Yeah, there is a lot of noise here with some of the non-core sales, and they just went out and got some bonds as well, and I think they're mixed up with a couple of things. One, to your point, the REITs are just getting hammered, right? Mm-hmm. And so I think it's a good buying opportunity for them, and I think this gets lumped in with like the NASDAQ, the growth stocks, right? And so I think it's getting a double whammy. Plus, it does have international presence, and with the strong dollar, I think I don't know if they're hedged at all in conversion, so I have a feeling, too, that that's another headwind for them that I think will be going away. And, Chase, to your point, they do have – it's mostly Europe and the Americas is where they are. They're in a couple of – they're in Australia and a couple Japan, Korea, friendly nations. But for the most part, all their centers are in good, strong economies.
Yep.
And geopolitically safe economies. So.
It's an interesting concept. I like the concept as a – kind of like what I call a big dumb business that there's not much going on having the data centers, but I just don't feel comfortable with some things that I'm seeing here.
I disagree with Brent here. I think there's some good opportunity. Not quite yet, as I said. The big thing is that liquidity that I would want to understand. But outside the liquidity, and again the FFO multiple not being quite where I want it, I think there's some good opportunity here.
Not at this price, though.
When it broke 100, I got my interest when it broke 100, and that's got me looking at it. Yeah.
Okay, John, mark your calendar. Give us a call back in a year. We'll see where we stand.
Yeah.
I got it.
Thanks for calling, John.
All right.
Bye-bye.
Thanks.
All right, that opens on the phone line 833-288-0973. That's 833-288-0973. 0973. All phone lines are open. Let's talk to Harrison Johnson, our financial planner. Harrison, good morning. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Good. I know you got a great topic today, so I'm going to let you share what the topic is, and we'll talk about it.
So I wanted to remind everybody to go take a look at your 401k. People seem to kind of set and forget their 401k contributions and what it's allocated as, but it can grow to be a really big piece of money in retirement if you let it. So people think of pensions as being great. Maybe you'll get 50% of your income for life or 80% of your income for life. But if you invest 5% of your pay and then get a 4% match to your 401k, and you do that from 25 to 65 with an 8% rate of return and then withdraw 5% of that in retirement, your retirement income would be 115% of your pay, which is a lot more than any pension. So they can be, large income sources and large accounts if you let them. But make sure you're getting the match on there. But even if there is no match, you still get a tax deduction. You still get tax deferred growth by contributing to that 401k. The match is nice, but it's more of a perk and not the primary reason to contribute. I see too many people that are like, oh, my stupid employer doesn't give me a match, so I'm just not going to put anything in there. And it's like, it's your money. You're the one that gets the tax benefits and the tax growth. So, make sure you're contributing to that. As far as the investment goes, the default investment is usually a target date fund, which can have higher fees and usually too much bonds in there, especially if you're younger. So, you want to make sure that if you change employers or you start a new 401k or whatever it is, you go in there and look at that investment allocation and choose what is really more appropriate. Usually there's some core funds available. Maybe you can find a large cap value fund or something like that that's going to be a lot better in the long term than just a regular target date fund. Another thing I see is people might have too much cash or stable value set to their 401k. Like, I talked to people, and when COVID was going on, they, went to cash and then never really changed it. And it's like, you need to be looking at that account, especially as you're adding to it, because it's going to need to be reallocated on an ongoing basis. Really, you should look at it every quarter or so. And then when we have times like this, when there's a lot of volatility in the market, it's usually good to look at your 401k and see if there's any reallocation that needs to be done. And, going forward, we're going into the fourth quarter here, so there's still time to increase contributions before the end of the year. The maximum this year is $20,500, or if you're older than 50, it's $27,000. So if you have some extra cash, consider increasing that contribution from your paycheck before the end of the year, especially if you've had substantial tax events this year, like the sale of a property, or maybe you got a large bonus or something that you weren't expecting that's going to push you into a higher tax bracket. Well, try increasing those contributions to help offset that a little bit. Or another thing you can look at doing is some 401ks allow Roth contributions. So, maybe it makes sense to go from the Roth to the pre-tax, or from the pre-tax to the Roth for whatever reason. So you can adjust that as well. So it's always a good idea to look at your 401k, make sure that you're contributing the right amount, make sure it's allocated correctly. Good to look at it on an ongoing basis.
And Harrison, quick question there. So people, I know if you have a 401k and you're like, oh, I'm not going to contribute to the 401k since they're not matching, I'm going to contribute to an IRA. But is it if you have access to a retirement plan that you lose the deductibility in an IRA, or is it if you contribute to
Correct.
a 401k?
Correct. You have to have access to it for one day of the year. So even if you retire at the beginning of the year, but you had access to it, then that will put you into that income limitation where if your income is too high, you cannot make deductible contributions to an IRA. Where a 401k, there is no income limit. Anything that you put in there pre-tax will be tax deductible to you.
And I guess there are some benefits with the IRA. You got a lot more flexibility in the investments and so forth.
But if you have access to the 401k, you don't do the IRA.
Yeah, but I'm just saying, but you can. You're right. But on the other hand, too, just like what is the break point on the salary? Because what's an IRA limit now? 6,000, I guess it is. Yeah. So what is the break point on that to where you could put 7,000 in your 401k, but only 6 in the IRA? You just lost $1,000 deduction.
Yeah. So. Yeah. And I think it is so important because I think some people are like, oh, I'm just not going to do the 401k because my employer sucks. And it's like, that's just a terrible attitude.
Right. And again, you're the one losing. Your employer sucks. Your employer, they did maybe pick the 401k plan, but still it's not the 401k plan of the employer. You're actually doing it, and you're the one losing out on doing that. And the other thing, too, Harrison, I was thinking about, too, you talk about the catch-up provision, age 50. I know it's hard right now, but gosh, you got 10, 15 years. This is the time to be playing catch-up because things are on sale now. Doesn't mean they'll turn around tomorrow, but 10, 15 years from now, gosh, you'll be so happy that you really maxed out. What you said it was, 27,000, I think you said was the number?
27 this year, and then that's going to be going up to, I believe, it should be going up to $30,000 starting in January.
Yeah. You want to find that money, put that in there, because if you're behind on your retirement, what a great time to catch up. But you do have to do the right investments. You can't just do something crazy like Bitcoin. So.
Well, you can't really do Bitcoin and 401ks, luckily, but, or cash.
Okay, all right. The meme stocks.
Yeah.
Can't do the meme stocks in there. Right. Don't try to play catch up that way.
Or a target date fund.
Yeah, target date fund. Yeah. So.
And I'm saying don't do a target date fund.
Don't do a target date fund. Right.
Yeah, and I think a lot of people too. You hear this advice. Oh, just don't look at your 401k during these bad times. No, as you said, Harrison, this is a great time to look at it. You have to understand it's probably going to be down. But you need to understand why it's down, because I think so many people have done these target date funds for the last few years because it was easy. You set it and forget it. And all of a sudden it's like, oh my gosh, I thought this was supposed to be safe. I thought I was supposed to have 40% in bonds because I'm retiring in a couple of years.
Right.
Oh, bonds go down when interest rates go up? Why didn't anybody tell me? This is a great
exactly
time
right. So,
to get out of those target date funds.
Yeah.
I mean,
go ahead, Harrison.
bonds definitely could be down 20% year to date, and that hasn't really happened. So, those target date funds on the equity side, it's usually more heavy towards growth, which has been crushed this year. And then on the bond side, it's corporate bonds, which have also been crushed. So, you might think you're safe, but, you could definitely be down 25% year to date in a target date fund right now.
And it's very important, as you said, not to look at your 401k. Well, you should. No, you may not have to, because you should have an advisor, like a good financial planner like Harrison, or we do it for our clients. So we know what's going on behind the scenes. But the average person, if you don't know what you're doing, make sure you hire somebody that knows what they're doing to look at that 401k, because you don't want to be in the wrong place in that 401k or your investments, any other investments. You have to have a qualified eye to look at that. But yeah, a lot of people, they should not be looking at themselves, have the professional look at it. So, Harrison, thank you very much. You have the great rest of the Saturday, and we'll see you on Monday morning.
Thanks, guys. We'll see you Monday.
Okay, bye-bye. Again, as Harrison Johnson, our financial planner, he is a CFP. He's on a salary. He does not sell any product at all. If you want an unbiased opinion on your financial plan, or maybe you don't have a financial plan, you get a free consultation with Harrison. You can give him a call at the office at 858-546-4306. That's 858-546-4306. Or you can go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com, and you can sign up right there or contact them that way. So very important to look at those investments there. One thing I did want to talk about, Apple this past week, it dropped plans to increase production of the iPhone 14, saying demand was not as strong as anticipated.
And the stock fell while the market was up on a particular day. Of course, the market was down yesterday, but Apple was down again yesterday, quite large. And the big problem could be is if sales and earnings are worse than expected. Again, this 14 was supposed to be, a big cycle for them. And you're supposed to see growth in sales. All of a sudden, what if sales don't grow? I mean, that's... And not even what if they don't grow. What if they don't grow as fast as people anticipated? We talked about this with Costco. You can't trade at, I think, Apple's still around 25-ish times earnings and not have growth. You got to keep growing to justify those higher multiples.
And Chase, I pulled up some numbers for Apple because I want to kind of look at that, and maybe you can do a little bit as well. But their 1 year earnings per share growth, 7.8% versus 9.9% for the industry. So you're paying this high multiple for them, but yet you're not getting the earnings per share growth that the industry is getting. Now, over the 5 years, their growth was 22.3%, but they're not going to return to that anytime soon. You are paying 22.8 times earning above the industry of 21.9. Price of sales, 5.9 versus 3.9. Price to book value, 38 versus 230, so that's a positive. Price to cash flow, 19.2 versus 19. That's about the same. Their PEG ratio, 2.3 versus 20.9. So that is still a very positive number to look at. Their dividend is laughable, 0.7% with a 14.6% payout ratio. You got all this cash. Why aren't you paying in a dividend? We also looked at the balance sheet. Not as good as I thought it used to be. The current ratio, 0.9, same as industry. Debt to equity, 2.1. I know they do buy a lot of stock, which does bring down their cash. But I was disappointed on that. Their net profit margin is still very good, 25.7 versus 17.5. Return on equity, 171%, industry 165, because I believe Apple accounts for a lot of that industry, but their equity is so low versus their return on equity.
Yeah, and I was just kind of looking at some of the items here with going forward, their earnings are estimated to be $6.46 in 2023. We will be shifting actually out to September 2024 after this report because they report on a fiscal basis. So very curious to see as that could have a big impact on obviously the target sell price for us and the numbers. But I mean, I look out to 2023, they're still trading about 21 times future earnings. 2024 still over 20 times future earnings. And earnings per share are only estimated to grow 5% in each year.
Yeah.
And that incorporates the fact that they buy back a ton of stock. So how much is their net income actually growing? How much is their sales actually growing? If you're only growing earnings per share at 5%, that could be a big problem. And again, 20 times earnings for 5%. I can find a freaking food company for 5% growth on an annual basis and not pay 20 times future earnings.
Right.
And the nice thing is food companies don't still have the heavy reliance on the iPhone, which still makes up about, I think it's about 50% of their sales.
Right. And the other thing I looked at, too, was their cash is declining. Back in 2019, they had in cash, which is your short-term investments in cash and cash equivalents, of $107 billion. That's now $48 billion in cash there. Their other cash is probably down here. I believe they put it, their longer-term investments, I think it's in other non-current assets, is I believe where that other cash is, which shows $183 billion. Now, that is up from 2019, but that means it's longer-term, which means there's more volatility there, so it's not really cash, which that could be declining, not increasing if it's not invested well.
And the thing I think is interesting, people are like, yeah, but their services are growing at 20% a year. Great. Their services isn't a separate business.
Right.
You know, I look longer term, maybe the services will be more and more of that business, but that means that 20% growth is going to get smaller and smaller year over year.
Yeah.
That's going to be an important reason why you have to look at the whole business for Apple.
Right.
And maybe it's not the iPhone 14, maybe it's the iPhone 15, but I'm still a believer that one of these iPhones is going to miss, and you're going to be stuck holding the bag for a company that you overpaid for.
Yeah, yeah. And again, great company, great services, but you got to realize what you're paying for that. And what you used to pay for was the big growth. Just don't see that coming along. So you could see, and again, I've said that, you could see Apple fall below 100. Oh, that would never happen. Never say never. So be careful. One caveat there is that a lot of people just love the name, and they may hold it too long. So we'll see. All right, phone number is 833-288-0973. Let's go down to Chula Vista and speak with Michael. Michael, you're on the Smart Investing Show, Brent Chase. How can we help you out?
Good morning. I'm calling about Tyson Foods, symbol TSN.
Okay, and do you hold that or looking at buying it?
I have a small position. I'm looking to add a little bit to it. I had a question before you go over the numbers.
Sure.
Just in general, at the top of the show, you'd mentioned the strong dollar. I'm just wondering how that affects your analysis of a company, if it does at all. Does that factor into the numbers you look at, and how might one look how that affects a company, and would it affect something like Tyson Foods?
Well, I mean, we always do look at that, and we buy pretty much 100% American companies because we don't like to buy foreign companies because of that. So the strong dollar for us, as far as what we're buying, doesn't really come into play, because if it was a foreign company and we're, let's say, a food company, we know we'd be in trouble because a strong dollar would make those foreign money come back over here worth less. So it does cause problems. But since we buy only American companies, the strong dollar, we don't look at for our companies as much as we do with the economy.
Yeah, and it still impacts our companies because Tyson does sell all over the world, and one of the things that they're trying to build up is their international sales. And one thing that I would say in periods like this is, even though we're buying American companies, you want to understand their distribution of sales. I mean, we had a high-end kind of retail company years ago, and they had a lot of sales in Europe. So we knew that was a potential risk, was if the currency fluctuated the wrong way in Europe, it was going to ding their earnings. Now, the benefit is the analysts that we look at here, when we're looking at the numbers, they know about the strong dollar as well, so that's going to put a peg on their sales, their earnings. So it is going to be factored into the analysis going forward, and it is something that we do look at, again, as a distribution of the sales across the world, because we're not just going to turn a blind eye to it, But with that being said, if their sales and earnings are getting hurt by currency fluctuations, well, I'm still paying 10 times future earnings, even with potentially dinged earnings overseas.
Yeah, I guess I was saying it does all come into the end play there. But again, they are paying the higher dollar for their manufacturing, or actually for the product. So, yeah.
And we did have a company a couple years ago. It was a really interesting company. It was, give it away, it was a little glass company is what they did. Right. And they would actually have a lot of business across the world, and they had a lot of currency hedges.
I say the hedges, yeah.
What they would do is they said, it makes our earnings more volatile, but it gives us a more precise estimation on future cash flows, because we know with the currency hedges what we're essentially going to be locking in place in that. So that's always something, too, that you can look at with your businesses. If they do have high overseas exposure, well, what are they doing to hedge against that?
Yeah. And I do remember that made the earnings very volatile. Like, the stock will go down because of that. So, but again, long term, it made sense. So let's go back to Tyson Foods. They're in the industry of farm products. There's about 1.7% float on it, so no one expects the stock to go down. 87% institutional ownership. They have a PE ratio of, 5.9 versus 9.7 for the industry. Price to sales, 0.5 versus 0.4. Price to tangible book value, 9.5 versus 9.2. And the price of cash flow, 7.8 versus 21.8. A very good PEG ratio of only 1.1. That's well below the industry at 4.4. Now, their earnings have grown by 18.5% over the past, 33.5% over the past year versus 31.9%. I was giving you the 5-year earnings per share growth at 18.5. Sales over last year up 11.3, below the industry at 38.4. Their 5-year estimated growth is a 7.5, about the same as the industry at 9.2. They pay a decent dividend of 2.8%, only use 15.9% of their earnings to pay that out. I think that's about the same payout ratio as Apple had, paying their 0.7. We do see that they have a current ratio of 2, same as the industry. Debt to equity, very good, 0.4 versus 0.7. And a net profit margin, 7.8 versus 4.6. Return on equity is 21, well above the industry at 15.8.
Current price here for Tyson, $65.93. 52-week high is $100.72 in the 52-week low, $65.85. Year-to-date down 23.1%, about right in line with the S&P, down about 24% there. But going forward for Tyson, I go out to September 2023, I see estimated earnings per share is $7.64. Gives us a target sell price of $126.82. I mean, that's a close to 100% gain there, based off the current price. I think it's a great opportunity. I don't think people are going to be eating any less protein here over the coming years. And one thing I will say, too, is their balance sheet. They've done a great job cleaning up that balance sheet. Mm-hmm. Could be a good sign for future shareholder returns, because once that company pays off debt and they have that cleaned up balance sheet, is now they have excess capital that could go back into perhaps higher dividends, higher stock buybacks. So that's something I'm keeping an eye on, is now that they clean that up, I think it could become even more shareholder friendly.
And Michael, keep in mind that this is a food company. They benefit from inflation, but it's like a lag. Is that prices go up, their earnings don't do as well because they can't get it there, but they will benefit from the higher prices down the road, because one thing that happens is that prices will go up, they'll come back down, but the profit margins seem to stay a little bit better than before inflation, but it takes probably 12 to 24 months for that to happen. And again, the meantime you're waiting, you get that, 2.8% dividend. So it's a good, safe company. Again, it's on sale right now. Doesn't mean it'll be off sale tomorrow, but I think it's a great company to hold in the portfolio long term.
Okay, I appreciate that. Yeah, I really like the company. Just, I've got the mindset. It's just human nature. I'm thinking, hey, maybe I can get it at 60. Maybe I can get it at 55. But it sounds like your philosophy, if you like the company and it's a good price, go ahead and go for it. It'll work out in the long run.
Yeah, because you might pay 65 for it, and then next week, shoot, now it's at 60. But look at where you'll be 18, 24 months down the road. And if you collect that 2.8% dividend, and then, 2 years down the road, it's at, 90, 95, like, wow, that's a 50% return pretty much. And I got the dividend. So.
Yeah, because then you get kind of stuck into that whole concept we were talking about at the beginning is, what if it goes up to 70? Okay, I'll wait till it goes to 65. Now it's at 80. Yeah. That's why it comes back down to the business. And as Brent said, you got to understand it could go lower, but where's it going to be 2 to 3 years, not 2 to 3 weeks?
Yeah. All right.
All right. I appreciate your help. You guys have a great weekend.
You too, Michael. Thanks for calling. Bye-bye. All right, I think we got, 3 minutes left here. Okay, let's go. We can take a little bit of time. Let's go down to San Diego and speak with Jim. Jim, you're on the Smart Invest Show. Brent Chase, how can we help you out?
Hi, Brent Chase. I have kind of maybe a little bit unusual one, DVAX. I was wondering what you see in the numbers there. Dynavax?
Dynavax Technologies? Yeah, well, let's take a quick look at that. Do you hold that or looking to buy it there?
No, just looking at it, yeah.
All right, well let's take a look at Dynavax Technology Corporation, symbol DVAX. They are in the drug manufacturing specialty and generic industry. That's quite the industry. Wow, float is 15.7%. That's a pretty heavy float, which could make the stock move up dramatically, or could mean that the stock is headed downward. 92.8% institutional owned. 6.5% is a PE ratio versus the industry of not material. Price of sales 2.3 versus 1.9. Price to book value of 3.1 versus 1.9. Price of cash flow is 10.3 versus 16.6. No earnings per share growth showing up, so I guess they have no earnings. Their sales are up 155%, so it sounds like a major growth company hoping something major is coming out with some drugs here. They do not pay a dividend. The balance sheet, good current ratio, 2.8 versus 2.5. Debt to equity looks okay at 0.6 versus 0.7. Net profit margin shows a 34.6% versus a -3, so I'm not sure why we're not seeing any earnings growth there. Maybe they didn't have earnings growth a year earlier. We do see return on equity 54% versus 9%. Kind of confusing. What do you got, Chase?
Yeah, current price here for DVAX and Dynavax Technologies, $10.44. 52-week high, wow, $21.39, and the low, $7.26. See, year-to-date, it's down about 25.8%. It's a decent-sized company with a market cap of about $1.3 billion. But this is where it gets really strange. December 2022, estimated earnings per share, $1.69. It looks like year-over-year growth of 196%. Forward PE based off the end of this year, 6.18. Great. December 2023, negative $0.04. So they're estimated to lose money. What the heck is going on here? That makes absolutely no sense. So that's very strange, Jim. With that number, I'd definitely say stay away.
And also, I do see, going back to the analysts here, going back 90 days, the estimate was for 2023, 69 cents. 60 days ago, 70 cents. Now, as you said, negative. So not the right direction.
Yeah.
That sounds like it.
Yeah. So,
All right.
All ready?
Thank you.
All right, Jim, thanks for calling. And there's the closing bell. Wow, we timed that just right. Thank you for listening to Smart Investing Show. It is for informational purposes only. It should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. Some great information there. And for more daily educational information, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk to you more next week right here on the Smart Investing Show.
To think that I did all that, and may I say